All right, the markets finished the week on a high note, relatively high note. It wasn't so bad. We're going to break down today's move, though. There were some very interesting patterns that you would have not expected if the markets were up today. So we're going to talk about what those patterns are and what we should expect in terms of how bullish we actually are. And we're also going to take a look at this idea of this soft landing. Are we in an economic environment where we can head towards a soft landing with where the Fed has raised rates to? So they're very similar. I went back and looked at some commentary for another period of time that is almost the exact same conditions that we have right now in the markets to see how we compare to that time. So we'll talk about that and see what the likelihood of this soft landing is. Again, taking a look at some really important intermarket relationships that had some patterns that you would not have expected today and their impacts on the markets, especially kind of what we expect next week or after the holiday. And then we'll take a look at our trade idea as a stock that's been that's kind of matching the market in terms of not really establishing a strong trend right now, and how can we trade that. So let's go ahead and get started. Today is Friday, September the 1st, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get started, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video, where I take a look at all the current trades we still have on from old Market Outlook videos, see whether we should stay in them or not. We actually closed out a trade today. And we also put on today's trade idea before the market closed at 3:30 Eastern time. Come down to the bottom, click this heart. It opens up a new tab. Hit that like button there. Same thing here. Click on this thumbs up icon. It opens up this new tab. Hit that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. That's all we always ask for it. It's a big deal to us. And again, our goal is to get to 100. We got really, really close there this time. So thank you again to all those who click on these like buttons. It goes a long way for us. Those who don't, you can do right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a good week. We started off the week, let's see, this is where we started off the week, right here. So we started off the week with the near-term line in bearish territory, the intermediate line barely getting out of bullish, coming off of a bearish near-term peak. And then we really kind of took off. Like we had the first 3 days of the week were up to the upside. Especially here this Tuesday was the big breakout day, and the rest of the week was a matter of, we got the bear tag, right, which I explained in the last Market Outlook video. A signal that an intermediate decline or rally could begin. that usually starts these intermediate rallies when you get these bear tags. See over here on the left. So here we are again with the same signal, and again, usually like to follow through. You can see over here we had we were up 1.25% by the time we got the bear tag. And then, a few days later, we were up over almost 3.5%. So here, we were only up 1/3% on the bear tag, and 3 days later, we're only up 0.75%. We're not the 2.5% the mark that you like to get above to really establish the strength of a new trend. And we don't have that yet. Hence, that's why, again, a few days later after the bear tag, you had dark green shading and a green line. 3 days later, right? 3 days later there, dark green shading and green line. We have dark green shading, but we don't have the green line because we're not really pushing up. In fact, now the near-term line is actually close to breaking back down below the intermediate line. It's one thing for the near-term line to be below the intermediate line when it's in the reversal zone, but when it gets below it while it's traveling in between reversal zones, again, that's a negative sign. Again, about the same. It's the same negativity as the intermediate line on a different time frame, of course, as the intermediate line being low market sentiment when it's between reversal zones. So that's something to keep an eye on next week, right, as we head into a new week. If you take a look at the weekly market forecast for the S&P, again, here's where we were last week. Short-term sentiment was improving, had been oversold for multiple weeks in a row. had been improving. Last week got out of the reversal zone, continued that move up this week with a little bit of a gap too that still hasn't filled in, but continued that move up this week. Again, the intermediate line is down out of the reversal zone, barely 400th of a point. And the near-term line, of course, is still below it. Again, it's not a bad thing to be below it when it's in the reversal zone, but it is it's not the best thing to be below it when you're not in the reversal zone. So it's something to keep an eye on next week to see if we can follow through with this week, or do we come back in. Let's take a look at some of the other indexes. The NASDAQ in particular, since that's been a big driver of bullishness, is those Magnificent Seven. Again, you can see this same exact pattern, the momentum line back in. So here's the idea, is like, okay, how likely are we to get the near-term line to cross below these intermediate lines? And the likelihood is very high, considering that the momentum line did not get into the upper reversal zone, barely got in the bullish territory as it was, and is already back in the lower reversal zone, much less bearish territory. So that's the reasoning. That's the idea why the likelihood of this staying above the intermediate line, just bouncing right back up, is lower, and more likely that we continue down on a near-term basis. And eventually potentially get a new bear tag, right, that would start us up, because sometimes you might get multiples, but in fact, right, you might actually get a bull tag. The near-term line, intermediate line, you have to roll back down, and you have to close back below the moving average to get that. Let's take a look at the Dow Jones Industrial Average, which has kind of been doing its own thing because it's not above the moving average yet. The intermediate line's not in the upper half of the chart or in bullish territory. The near-term line has dropped below it. So again, you can see this great breakout that we had on Tuesday, closing at 34,852. Well, we're below that level today, 34,837. So we're not able to really follow through on that strong day on the Dow, and yesterday you got to an extreme low on the momentum line. So again, and you're still almost in the reversal zone as it is, well in the bearish territory. So that kind of gives you an idea of the lack of bullishness there. And of course, the Russell 2000 just got you the bear tag today. This is the first day. Again, it's only 0.08 of a point, so it's not the most bullish of bear tags. Again, for example, when you got the bear tag over here, you were 1.5% above. A couple days later, you were over 4% above. Even this bear tag that you got, that you were only 0.15 of a point above, a few days later, and you were, over 4% above. So, okay, so we're not getting, and over here you had a bear tag, semi-bear tag. You didn't have, it actually kind of had everything you needed. You had dark green shading as a reason why the intermediate line was still actually kind of barely rising, but you were above 50 at the time. So you had dark green shading. Light green shading is what you need. So it needs to be below 50 to get that bear tag like we are right now. But essentially the same pattern. And that day you closed 0.4% above the 30-day moving average. And a few days later you were over 5% above. So, again, if we're going to really kind of change this intermediate trend and not turn into a bounce, right, a bear tag that bounces back down, because that can happen, right? It's less likely that it will bounce back down, but that's a possibility. Either going to bounce down to new lows or start a new intermediate run. Either way, it's not, it's a pretty good signal that you're going to get a pretty decent move in either direction. And again, the odds are for a bullish direction. But the possibility is there for the bearish, and what will increase those possibilities is we don't follow through on this bear tag with a bullish move, strong bullish move in the next day or two. And considering that the S&P and especially the Dow is actually down since that same Tuesday peak, Tuesday being the day that the S&P and the NASDAQ got the bear tag, since they haven't really followed through with any significant gains, the likelihood of this following through with any significant gains is lower, which would open up the likelihood that the near-term line follows where everything else is going and comes back down to the downside. So that's kind of what's going on there. Here's the weekly chart for the Russell 2000, which has been, again, a lot closer to the moving average, a lot closer to the 200-week moving average. than the other indexes, and a kind of a little morning star candlestick pattern here, reversal, and we'll see if that, again, if we follow through with that. The near term and momentum lines rising, but the near term line still below the intermediate line as it's between reversal zones. So we need another week to push through that and really clear this. So it looks, we had a good week. We had a really good week here. It wasn't the strongest week. We didn't get a lot of follow through from Tuesday. The Dow didn't get any, like it's actually down from Tuesday, and the Russell's just now getting that bear tag. So it's not, while there were some good signs, it wasn't clear-cut signs that, hey, 4,800, here we go. Let's back up the truck, and we're going to overcome the seasonality of the month of September, which is notoriously bad, and everybody's been talking about it. There's a lot of technical signs here this week that we can be able to overcome that, and the reality is there's not. And the idea is, maybe we're not nearly as strong. Like maybe this isn't the beginning. We'll know by Wednesday of next week, because within a day or two, the Russell 2000 is either going to get up 4 or 5% above the moving average, or it's going to do what the S&P did and falter and eventually again lose that bullish strength that we've had. It's hard to start an intermediate trend without juice, right, to get it going. And as we talked about, this intermediate pullback that we've had in August didn't produce very much juice to be able to set up a new intermediate run. If you look at some of these other indicators that we talked about on Wednesday, we still have, like when you're looking at this chart, what's the signal for a bullish reversal coming off of some weakness? And that is getting back above the 10-week moving average, which is what the green line suggests, and getting a bullish candle. In this case, much higher close than what we had last week. And then obviously a higher high, a little bit of a lower shadow, so it's got a little transition, and it's not the biggest bullish candle. But next week we're going to start off with a pretty decently bullish candle. So barring a bad week next week, even if it's just sideways next week, like no gain at all, that's like a really small range week, the Hakinyashi candle will be pretty bullish. So, and if we have any kind of bullishness, it will be a pretty decent bull, especially if we can get back above 45.34, which is that 78% Fibonacci retracement of the entire correction. There we are set up. I mean, like this does have the signal, just like the market forecast, the bear tag. We don't have the dark green shading green line yet. That's the signal there, but you're close, and same thing here. Where you're getting a lot of good signals here that suggest a bullish reversal from the weakness that we've had. On this chart, the bullish reversal signs 3 green arrows that persist for more than just a day or two. And that's the case for the S&P and the Dow or NASDAQ. We've had 4 days. Now they haven't really been, the MACD has already rolled over on the NASDAQ. It's been flirting all day on the S&P with rolling over. And that's how close it. So it's not really rolled over very much either on the NASDAQ. The Russell just barely got, right? You got the bear tag. It just barely got the 3 green arrows here. We got to follow through with more than just a day or two of that. And of course, the Dow still doesn't have 3 green arrows yet. So we kind of have the signals, but we kind of don't. Looking at the S&P 500, on this chart, we are well above the 30 and 50-day moving averages. In fact, the 8 and 17-day are both crossing above the 50-day moving average. Stochastics is in bullish territory. MACD is in bullish territory. Like I said, but the histogram is kind of peaking, so you don't know how much more it's going to rise up. We'll keep our eye on that next week. Again, last week, going into it, the MACD was still kind of in the mode of, here to where we were. The histogram was rising, and we were close to crossing above zero, and stochastics was rising above its moving average. So we were able to maintain that. Now the question is whether by next week is that histogram going to roll back over, and again, of course, stronger likelihood of that's going to happen. We are above the value area, so pretty bullish from that perspective. Again, IWM, which is looking a little different. Again, it's at that 30-day moving average. The 8's about to cross above the 17. That's why your MACD is about to go over zero, and stochastics is rising. So it's kind of looking a little bit more like similar to what we saw late last week, early this week in the S&P 500. And again, above the value area, the one-year chart. So it's trying to clear above some resistance level and get some little bit of escape velocity, so to speak, and pull away from the magnet that would be drawing it back down. So take a look at some of these other oscillators. So again, what are you looking for here? Well, you would like to be above 30 and below 20 to really establish a trend that can persist. To get at least a weak trend starting, you want to be above 25 on either one of these indicators, in this case the positive indicator, and we are. So we do have a weak trend going, but we need to get above 30, below 20 on that. The NASDAQ 100, you can see, is above 30 and below 20. So, and you do have the dark green shading and the green line on the NASDAQ. IWM, that's not the story, right? They're both below easily 25. So as of right now, with the bear tag, there is no trend going on IWM. And really, for that matter, not on the Dow either, as the Dow's got both lines below 20. So you see how it's like, it's not really, not really that strongly bullish here. The RSI, the signal here is to get above 150, ideally, and we did yesterday, and above 60. And we did that barely yesterday. We're back down. At least we're above a positive 100, but we're not above 60. We're still, this is actually this little red box, which is when you drop below 50 and you confirm it with a drop below 40. This is actually persisting, right? So go to today. So I can't necessarily change that green. I mean, it's gone above 50, but I need to change it to green. We need to get above 60 to actually change the trend. We don't have that yet. At least we are above 150, again, barely. So it's not the most bullish pattern. Like, you ideally like to get above 150, pretty clearly, like it did over here when we started that run. And even over here, it got, above 170, but we were at 159. So, I mean, that's not the most bullish breakout of that, level that we need to see. And then finally, looking at the Bollinger Bands here. Oh, we didn't look at the Ichimoku cloud. Let's take a look at that one here really quick. Above the cloud, right, above the blue line, the green line's about to be above. We're above that pink area, right, which is this decline, right? This decline here plotted forward is that green area, or pink area. We need to be above it by the time we get to it, right? It's plotted forward 26 days. So we need to be above it by the time we get to it. Of course, the likelihood of that happening increases if you're above it at all. So we are above it, which means we're a pretty good chance. Now, the rate of change is not positive. It's still negative. And, unless we can stay here by the end of next week, if we have any kind of decline, then it will stay, back below and be negative again. So kind of keep an eye on that. Again, whatever bearish trend we had is gone, but we don't have even a weak bullish trend established yet. Not even a weak bullish trend. So that's the issue there. And then the Keltner channels, you can see, we are in the upper quartile. Again, barely though. So this is not the kind of move that really suggests, hey, here we go, new intermediate rally. We're pushing up against that Bollinger Band. Nope, we're not. I mean, we're up against it enough to get a little bit of a breakout outside the Keltner channels. That's why your dots turn green. But you're going to need a lot more momentum to push us through that. And obviously, we haven't had it this week. And again, based off the technicals, it doesn't look like we might, we will get it next week. Though, if we do, then we'll feel a lot better about, the move up to past 4,600, because you would expect to get past the higher highs coming off of a higher low. And then eventually, more than likely, get up to 4,800, which is not that far away. And there's, as we all know, a huge magnet there at 4,800 drawing the markets up to it. All right, now let's take a look at the volatility index, and here's the kicker. The VIX finished at 13.10, 13.09. If you look at that over the course of time here, that is, let's see, right here was our lowest close at below 13. We actually closed below 80% there as well on the 22nd of June. But you notice here that this is the second lowest day on the VIX. Not quite below 80%, well below 85% though, lower than where we got to at the beginning of June, the middle of June here. So pretty darn low level there. And interestingly enough, the VVIX was dropping along with the VIX all the way up into the last 2 days. The last 2 days, the VVIX has actually jumped back up to 82 after getting down to some pretty low levels here below 80. It jumped up back to over 82.5 now as the VIX continued to move lower. We talked about before on Wednesday just how extremely low that VVIX was, and now you can already see it bouncing back up, and usually that kind of precedes an increase in the volatility index itself, because this is the volatility index of the VIX. And so kind of an interesting pattern there with the VIX at such extreme lows, right? And again, not just relative to these other these other volatility indexes, the VVIX and the VIX 3M, but you also notice it's pretty darn low too, again, relative to that 200-day moving average. And, we had dropped well below the 50. We're well below the 8 and the 17 days. Which not too common to get that far down, but we're 28.5%. You can see outside of where we were in June and July. If I were to zoom out just a little bit for some context here, outside of that month in 2 years, we're in the 10th percentile. We got a red dot there. So again, we're extremely low relative to some of these average values that the VIX has had. Remember, we never did get. It's like that's how weak this intermediate decline was, that we never did get back above the 200-day moving average. I told you before that the last time we had such a weak intermediate decline, where we didn't even get a 5% drop, right, on a closing to close basis, was this November 2016. The volatility index did get above, right, and it did get above 105% relative to the VIX 3M. It did get up to really high levels with the VVIX as well. So all those factors that we didn't get now, we did get then, and we still only dropped, about the same as we dropped then. But that produced enough juice to be able to get a good run going into 2017. There's no juice in this current move that we have right now, because we're considering how extreme we already are to the downside, and as I mentioned before, how fast the move was to the downside. Of course, looking at the volume and the trading ranges has been light for most of the week. It finished, not surprising because it's a holiday, but again, it finished below average on both the range and the volume. The volume has been tapering down to the downside. The ATR was just barely under 4 points. The ATR is still barely over 1%, so we're not quite back below that 1% mark yet, but it's still been dropping, and so has volume. So really, really light moves. Again, following what was a breakout move. What's interesting is we did get a breakout here on the 4-week chart, right? We got the positive move up higher here on the Arun indicator. It's interesting that this is, again, every other time that we've started an intermediate rally, so here's our last one. We had this big long intermediate run. Here's our last one. You can see how high the 4-week channel was. Like, we had enough of a pullback that it produced, that size. If you follow my cursor over to the right, you can see where the current channel width is, and it's much lower. In fact, it's below 5%. You come over here to this intermediate, the beginning stage of that intermediate decline, again, much higher over here than where we're at right now. And over here, this intermediate run that we started on the day after expiration, you can again see just how big that intermediate decline was. That produced a pretty wide channel. Again, juice, right? It produced a lot of juice to start a new run. Well, the last time that we had an intermediate run start with the channel width below that 5% mark was right over here in November 2021. Again, it didn't have very much juice, and eventually that was the last run of that market sentiment rally, and we had our correction. Is this the last run of our market sentiment rally? I mean, will we get to 4,800 and that's it? If then, this one did get up to higher highs. Are we going to mimic this? Interestingly enough, we are at the exact same level. We closed that day right around 447. We're at 451 right now. So we're pretty much at the exact same levels we were then in October. This would be the middle of October of 2021. And then again, we didn't have a whole lot of juice left before we started the correction. Is that going to be the case again? That obviously remains to be seen, but that's obviously what I'm expecting going forward from here. All right, so I wanted to, as we transition out of what's driving this price action, I wanted to talk about a little bit about what comparing what we're seeing right now to what we saw in December of 2006. So December, I just saw like a report from Goldman Sachs saying that the recession odds for for the markets are down to like 20%. And if you go back, the recession started in 2007 in December. If you go back to December of 2006, right here, you can see that the 10-year was paying less than the 3-month. You know, again, when you think about like what kind of market pays more in a 3-month time frame than a 10-year, a longer duration asset class. The longer duration assets should pay you higher returns. There's higher risk involved with that extra amount of time, 10 years minus 3 months. So with all that risk involved with that, they should pay you a higher yield, a higher return. That's why that's why they associate these QQQ mega cap names as long duration asset classes, because they're higher beta, they have more risk, they pay you more return for that risk. The 10-year note should pay, and always for the most part does, except when the yield curve is inverted, should pay you a lot more than just in 3 months. That wasn't the case in December 2006. The yield curve was inverted. And again, the recession didn't start until a year later in December of 2007. So keep that in mind. Similar economic environment now, but to a much larger degree now, because we are 135 basis points to the downside, updated for today. So huge inversion that started over about a year ago, almost a year ago is when it inverted, and we've been inverted ever since. So it's been a long time, this entire calendar year, that the market has been saying, hey, we want to pay you more if we take your money for only 3 months, a lot more than if you were to give us your money for 10 years. And it's like, okay, well, who wouldn't sign up for that, right? And that should produce a lot of demand for those 3-month T-bills, bringing the yields down on the 3 because of all the buying, and it should produce very little demand for the 10-year, making its yields go up, and then uninverting the yield curve. That's how, I was on a space today, and the discussion was, well, the Fed doesn't care about uninverting the yield curve. The Fed doesn't do that. The market does that, because right now there should be a lot more demand for the 3-month bills than the 10-year notes, because of you're getting 135 more basis points in 3 months than you are in the full 10 years. So that's the idea behind this. That's why you should. And the reason why anybody would do that is because they're scared about what's going to happen in 10 years, the risk of what's going to happen between now and that 10-year maturity date. What's going to happen? Was my money going to be worth the same as it was then? What kind of market environment are we going to be in, where I just want to park it right now for like a CD for 3 months and be able to have access to my money again? So that's not the healthiest market environment, and that's kind of why that. But similar to the end of 2016, the volatility index is extremely low. If you go back out to see, we're at 13 right now, right? So if you zoom out, in fact, let's do it on both charts here. If you zoom out here to 2016, again, a year before the recession started, year 2006, sorry. The year before the recession started, where the odds of a recession were only 20%. So here is December. You can see we were in the teens in December of 06. At the end of November, we were right about just over 10. So we were just barely over 10. They're right around 11. Very, very low, and it had been dropping all throughout 2006 after a jump earlier in the year, and very low environment. Again, a year later, we were in a recession. So like by December of 07, end of November, December of 07, we were in recession according to the MBER. And you can see we had a spike in volatility there in February 27th of 2007, where the markets kind of hit the fan. We did pull back, like it was very short-lived, but eventually we had Bear Stearns, and then eventually, of course, Lehman Brothers in October, and volatility just never came back. Like we started the cycle up to the upside. If you take a look at it on the VVIX, same thing. go out to 20 years, and I don't believe the VVIX was in existence there. But again, you can just see how low that is. Oh, I wanted to show you the moving averages. That's what it was. If you go out again to 2006, again, when recession odds were low, but the yield curve was inverted, we were way below the 200-day moving average. And we had been coming down all these moving averages. So the VIX was really low and had stayed low for about another month or two before we had that end of February spike. Really, really low. Again, compared very similar to what we had now. We had the spike in volatility here early in the year with the regional banking crisis. Have been falling the rest of the year with a dramatically inverted yield curve. So the market is kind of like saying, okay, like there's very low recession odds, a lot of complacency given the conditions here where the market is not willing to pay more return for a longer duration asset class or assets within an asset class, within bonds, than they are in the short term. Especially when that asset class is extremely undervalued, right? Bonds are very oversold on a 1 year basis. So here's where the 200-day moving average. It's even that much more oversold on a long-term basis. So the asset class itself, these long-term assets have a very attractive margin of safety because again they are way below their 200-week moving average, whereas equities are quite a bit above their 200-week moving average. So again, that should create demand for cheap long-term assets in that bond market. But the problem is that again, because of the low returns, the low yields that they're giving. In fact, if you compare the 10-year yield to the core PCE that came out yesterday, you're not getting any positive real return. The core PCE rate year over year is actually higher than the 10-year yield is right now. So that's another reason why, again, that the market is why shouldn't a healthy market be able to produce a positive real return on this very attractive asset class that is extremely oversold and willing to be scooped up right at cheaper levels than normal? You would think that should produce a lot of demand for that, but it hasn't yet. You can see long-term bonds potentially producing a double bottom and not quite there yet. Down for the week. If you look at today though, if you look at today, it was really down, right? So that means yields came off of that bear tag it got a bear tag, 3 red arrows, and then bounced up right back above the 8-day. The MACD is turning slightly, the histogram at least is turning up, and it looks like it might avoid going below zero. That's a pretty significant jump in yields after getting that bear tag on the market forecast chart yesterday, right? We got that bear tag, or bull tag, excuse me, got that bull tag there, and boom, we're bouncing right back up off of that level. The other interesting move today was the dollar, right? The dollar bouncing back up, closing at its highs of the day. Not necessarily the most bullish for equities. In fact, it's the highest level for the dollar that we've had going back for quite a while. I mean, we're closing at 104.26. Over here, we close at 104.21. You have to go all the way back over here to close here. This is the last day we closed on March 16th. During the height of the banking crisis, the dollar now is as strong as it was then, and yet the stock market's nowhere near the lows that we saw in March. So the dollar has really bounced in the last couple of days to the upside. And you know what else has really bounced is crude oil. Crude oil has broken through these cluster highs, broken through this Fibonacci retracement level, and that goes back kind of a long term here. You can see that long-term rally off the COVID lows. So you're back above the 38% retracement level, barely. So we need to follow through on that. But it's the highest level on crude oil that we've seen since going back over here to November, almost a year ago, November 2022, when we were coming off those mid-October lows. So it's a strong level. And so today you had rising yields, rising commodities, and rising dollar. And that was your three-headed monster in 2022 that led to risk aversion, a lack of risk appetite. but not today, right? The S&P, now granted, the S&P wasn't up a lot, but it was up 8 points. So it didn't produce the negative sentiment that we've seen. But the trends of all those indicators it doesn't look like it's a one-time thing. It looks like they're rallying, and the fact that we are, not following through on this bear tag, and you would expect if those three different asset classes continue their moves into next week, that is not the most bullish macro environment for equities to flourish in. And these moves today are semi-breakout type moves that that ultimately can put some pressure on equities and keep them, again, in a seasonally bearish time of year, keep them down, in a seasonally bullish time of year for volatility. In fact, when you look at the seasonality chart for the VIX, you'll notice here that the VIX is down below, so the seasonal low for volatility throughout the year is right there at the end of July. And we did produce a low point there, a low point, the second lowest of the year. But still a low point during that time of year when you would expect that we would. We're lower than that low point now, but if you look at like where we're supposed to be, we're actually supposed to be way off of that. So the volatility is extremely low. Big time drop in the VIX when you look at the rate of change over this time frame. Big time drop in the VIX. Extremely low. So, and we're still not out of this seasonally bullish time of year. There is a bullish drop in volatility in September generally, but considering, again, how much we've already dropped now, you wonder if we've really pulled that forward and then some. We don't get anywhere near that July low point on that decline. And like I said, we're already below that here. So you can see how, from a seasonal standpoint, volatility is actually set for a pretty decent move to the upside, considering you're down 40% year to date already on that index. All right, now let's take a look at how the sectors performed here today. And here's another interesting element of today's move. So let's come here to September 1st, and then we'll break it out to the full week that was. And you can notice here, the big winners today were not XLK, XLY, and XLC. They were energy and materials, two very dollar-sensitive. Remember, the dollar rallied today. So if you looked at this chart right here, you'd think, oh, the dollar was down, right? And energy materials bounced because of it. Nope. The dollar rallied, and energy materials was still the big. Remember, energy has been the big winner during the bearish times for equities over the past year plus. Not the bullish times. It's usually been XLK, XLY, XLC. XLY and XLC are down here with utilities and staples, right? With these are safe haven areas, and of course, utilities and real estate are going to lag behind their interest rate sensitive areas. But financials are also interest rate sensitive. So they traded, as you would expect, with rising yields today. But commodities being up, despite the strength in the dollar, yields being up, have pushed these interest rate sensitive down. But it also pushed XLY and XLC down. XLK kind of outpacing the market a little bit, small gains, but really lagging behind these other cyclical areas, energy, materials, financials, industrials. These are not the areas that can lead a sustained rally. As you saw, as I showed you on Twitter yesterday, the QQQ closed above 2 for the fourth time since 2000, so in over 20 years. And all 4 times have occurred in the last 3 months. And you can see we're already back down below this. But look how big, and again, like the QQQ, this ratio is set up for a move to the downside relative to IWM, and that's traditionally, as you can see, the correlation is traditionally bullish, like positive. So if that ratio were to come down, again, there's been a few times where it hasn't. During COVID, the markets dropped and the Qs rallied. This ratio rallied, of course. We know why, because there was a shutdown. During the reopening trade, when the vaccine rolled out, the correlation also went pretty strongly negative. Not surprising, right? Because all the reopening trade stocks did well, and the really outperforming, really overbought Qs, the technology sector did not. And I showed you that. I believe I showed this on Twitter as well. When you look at XLK relative here to the S&P 500, again, it's had a big spike. XLK, sorry. it had a big spike in relative strength on the weekly chart. Big spike in relative strength here. Let's zoom out so you can see some context on that spike. And every time it has spiked on that, XOK goes nowhere relative to the market. Goes nowhere for years and years and years relative to the market. This one went nowhere for 2.5 years relative to the market after this big jump in volatility. And then now your momentum is extremely low. This is the lowest momentum that we've seen since coming off of since this 2009, 2008 levels. We haven't been below 98 on momentum. So again, a level of relative strength that's hard to sustain, that usually peaks. And then you can see the deep momentum that suggests that we're probably going to end up moving this red line down. And again, that also suggests that this is going to come down, considering it's, again, normally positive correlation. Again, outside of like a COVID or reopening trade. So, I mean, are we getting a reopening trade right now where we can really drop hard and fill in that gap and for the equity markets to actually rise, this correlation to stay in deep negative territory? That's not normal, and I don't see that kind of trade happening right now. In fact, I would expect the opposite, right, where this drops and brings XLK, XLY, XLC down with it. So again, another indication that, man, we might not be bullish this week as we think we are. In fact, if I zoom back out by the time to look at the whole week that was, you can see the safe haven area, not surprising, the safe haven areas were your weakest. XLK, XLY, I mean, this is normal. Look at this, all the way through the end of Thursday. That was great, right? All three of those up there, exactly what you would expect. But by the time this week was over, they're not the best up there. XLB, look at the big jump in XLE, financials and industrials, lagging the market a little bit, but jumping up a little, financials especially. And then, of course, your safety trades down there. So not the best end of the week, which again suggests we might not be able to sustain this run that we had. This run was more than likely just a bounce, right? If you go all the way back to when this whole decline started on August the 1st, right? This whole decline started here. Technology, you can see as of last week, technology, communication services, and discretionary were your three worst performing sectors over the course of the month to date. And so a lot of this week's move was just a rebound of a very oversold condition. Look at energy doing well during a period where those aren't. And considering it did well today, suggests again, this might just be an oversold bounce and nothing more than that by how we finished this week. All right, now let's take a look at our trade idea of the day, and we'll take a look at eBay. eBay has been in this really sideways move for months, right? Brief periods up and down, but pretty much for months. And currently we're on the bullish stage of this cycle, very similar to the market, just not as bullish as the market. We got the bear tag. We have moved up slightly, but the intermediate line still in the reversal zone, still below its market sentiment line. So not the strongest bullish pattern. You can see, we do have a bullish reversal and a green arrow on, but we're still in a death cross environment there. Looking at the 3 green arrow chart for eBay, we do have 3 green arrows. That's a good sign. The MACD histogram appears to be peaking, though it's still rising. The DMI is not very bullish, right? We have both indicators below 25. They're almost both below 20. So no trend going on there. The RSI and the CCI look a little bit better. The CCI is above 150, but the RSI is above 50, but it's not above 60 yet. So we haven't really confirmed, again, similar to the market, that bullish move. Looking at the Ichimoku cloud, we had a bearish trend going. We're still below the cloud. We're above the blue line, but we're still below the cloud. The rate of change still is actually it's been negative. It went from very negative to actually slightly positive because of the earnings drop there. But no trend going on at all. And then if you look at the Bollinger Bands, that are still all inside the Keltner channels, very, very low bandwidth, and we're pushing up against the upper in the upper quartile, but not very much. So not the strongest period, not the strongest bullish pattern that we're seeing here. So as a result, what we decided to do is to balance some of our directional trade we've been doing lately in these videos with some examples of some sideways action. So we've been doing that a little bit in our class port. We've had plenty of directional trades in our class portfolios as well. So in the Market Outlook live video we did today at 3:30 Eastern time, we put this trade on before the market closed. Bought the 20 delta, low 20 delta, bought that low 20 delta, sold one strike away. Position size fully. There's your break even because we don't have to worry about earnings. There's my break evens. So you can see, like, we've only been outside the break evens for the past 7 months or so, twice. It was very brief, and they were both extended on either side with clusters on either side. So, and we're right smack dab in the middle. And as you saw when I pulled up this chart here, there's a pretty big, strong point. We're in the value area. The point of control is one big volume node for the year. So that's a pretty heavy gravity pull. If it's going to be hard for eBay. And if it does break out of this with that big gravity pull, then we'll have a good directional trade. We're willing to take $456 of loss because that's what we're trying to get, and then we can transition to something that's more directional if it is able to break away from that pull. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video, join our website at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. Have a happy Labor Day. Good luck to all your favorite college football teams on the first week of the season, and we'll see you all on Tuesday.